So I decided I wanted to make a quick video for anybody that wants to buy a house or is interested in purchasing a house, but you don't understand like how they even determine how much house you can afford and the reason why I got a house that was under 200,000. Let me break it down in simple terms. To make a long story short, let's say you make $5,000 a month, right? So you make $5,000 a month. All right, whenever you apply for a house, they take half of that, and this is before taxes, by the way. This is the amount that you make before taxes. The amount that you are not bringing home is your net income. And I know it's crazy because you would think like, why would they look at your net income when that's not what you're bringing home? Exactly. That's why a lot of people are house poor.
Hey guys, welcome back to the channel. Robert here. Want to go over how you should estimate how much home you can qualify for. I'm getting a lot of questions about that. I got a comment here. If you look, one of the community members is saying, hey, can you go more into detail with the math? We're going to get into the weeds, but at the end of the video, if you just follow some of the tried and true assumption calculations, you'll see that you'll be spot on. Now, the reason I wanted to stop this young lady is as far as the lender, we wanting to do some nefarious work and qualify you on the gross opposed to the net. The reason gross income is used is because as a lender and making an assessment or trying to make an assessment about your income over a long period of time, gross income is more stable. Whenever we start looking at net income, then it's very variable because everyone's situation is not the same. When it comes to taxes, when it comes to other expenses, I may have, you may not have. So this is the reason gross income is used. You have to know what your net income is. You see what I'm saying? Lenders and folks that are lending money, their job isn't to babysit you, respectfully. And so this is why we do these videos. Gross income is used because it's a metric that can be measured consistently to assess your probability of being able to pay back a loan, opposed to net income, where there's too many different variables and things change.
But let's keep going. Whenever you apply for a house, basically they say, okay, you make 5,000 a month, then you split in half, so technically you make 2,500. Then they take your car payment. So for myself, because I had less than 10 car payments left, my car ended up getting paid off before closing. They didn't use my car as debt because when you have less than 10 car payments left, they don't count your debt. You don't count that towards your debt to income. So say you have a car payment that's $400. Go ahead and take that off. So now I have 2,100 left that I can use for quote unquote a house. No, then I have to take away my credit cards. I have 2 credit cards. The minimum payments are $25. So then they take that off. And then if you have student loans, even if they're in deferment, they do a percentage for that. Then they take that off. So it come out to like 1,700. We'll say like 1,700. Okay, then they have to take off the taxes because you have to pay taxes on your house, the insurance, and the whole escrow, whatever. They take all that into consideration, and then they tell you how much you could afford as a mortgage. So mine was like 1,600, 1,500 a month. So being that I only could afford 1,600, this is just on one income. We didn't do 2 incomes. We wanted to live off one income because we could be comfortable on one income. A lot of people purchase houses based on 2 incomes. We wanted to be able to save another income and live and survive off one.
When she went through her process, the lender went through backing out all of her monthly obligations or their monthly obligations that they had on their credit report that they were paying. She mentioned the 10 payment rule, 10 payment or less. That is something that a lender can use to help you qualify. You know you still have the payment though. And so you don't have to go that route, but most people do. And most lenders understand that, hey, this is a larger payment that's preventing them, in this case, from most likely buying the home that they wanted to buy, because that larger payment, that car payment, was eating into the debt to income ratio. And we have enough history, bandwidth, expertise to know that, hey, if this payment is going to be ending soon, meaning it's not going to be around, we're all right with making that assessment to let you move forward with a higher loan amount and remove that payment from your debt to income ratio. So I said all that to say it's not a bad thing. And the way people paint these things is like it's nefarious, that somebody's trying to put you in a situation for you to fail. No, they're not. You are the adult. You know what you can and can't afford. We got to start changing that mindset. No one is making anyone buy these houses. You're buying it because you want to. And these are some of the underwriting things that could be done to help get you over the hump and into a house that you want to. Also, what she's saying about the different debts and liabilities that she has, that they're backing out of her back end ratio, which I'll explain to you here in a minute, to get to a number where they can factor in how much home they should be able to buy. So just keep watching. It'll make sense here in a minute.
Whenever they say, okay, you can't go over 1,600 with a mortgage, that'll tell us how much house you can find. So technically, I was approved for 240 because there are some areas where the taxes and fees were less. So I could get a house that was 240, 250, but we decided to find a house under 200 because we didn't want a $1,500 mortgage for one, and two, we didn't want to have to put down a lot of money because we wanted to be able to save more when we got in the house, and our rent is the same amount than what our mortgage is. So yeah, that's how they figure out how much you can afford. Basically, they just take everything away that you owe, like alimony, child support, whatever the payments you pay each month that you have to pay. Not like light bill, water bill, stuff like that, but like the major bills. They take all of that and they minus it from half of your income, and that's how they figure out how much house you can afford. So you should definitely do that. Write it down and see how much you can afford.
I appreciate the young lady for giving you a 10,000 foot view, but here is the actual way a lender goes through helping you decide how much home you can afford. Okay. And so let's make some assumptions here as we get ready to move forward. And so the first assumption is making $100,000 a year in income. You may be making less. That's not the point. The reason I'm using 100,000 is because the person that asked, remember I put the comment up earlier in the video, they were saying, hey, $100,000. Don't let it trigger you. You can plug in whatever your gross or your annual income is. Second assumption, that this is a W-2 employee. It's not a business owner where we have a lot of variables. We're looking for the consistency of the income over a period of time. Now, here is the takeaway before we get into the numbers. If you take your gross income, whatever that is, and multiply it times 2.5%, this will be a great number for you to understand how much home you can afford. I'm going to prove that to you as we go through these numbers. If you want to be a little more aggressive, depending on where you are, your debt load that you currently have or don't have, and you want to be higher as it pertains to ratios, you might be able to get away with it, then 3.5% times your income is what I would do to get what the maximum purchase price would be. So this is very comfortable. This is stretching it. Okay. But if you just adhere to those industry standards, you'll see here in a minute, you don't have to go through all the machinations because you'll understand that these are good starting points for you to help decide what's going on. Now that we got that under the way, we're going to be looking at an FHA loan. Okay. We're FHA loan, and we're going to understand what FHA loan ratios are. There's something called a front end ratio and a back end ratio. Long story short, front end ratios for FHA, they say, hey, if your mortgage payment, principal, interest, tax, and insurance does not exceed more than 31%, in this case of the $100,000, then you should be good. Back end ratio is 50, and in fact, they'll go as high as 56%. Should you? No. Do a lot of people? Yes. Again, this is why we're going through this math, so you can understand what it is that you decide to do. Your front end ratio is 31% of $100,000. It's $2,500 a month. And I've always rounded up because we can't do cents. And then the back end ratio is $4,167, or it represents 50% on an FHA loan. So what she was talking you through as she was doing that, she was saying, okay, once their lender determined what the back end ratio was for them, in this case, it's $4,167, the lender then started backing out the payments that they have on their credit report, or I should state it this way, the payments that they're going to be responsible for that we calculate in the debt to income ratio. And they do not include utilities. She said that in her statement. But in our example, we're going to say this person has debts, monthly obligations of $550 for a car, $300 a month for student loans, credit card bills $250, loan or installment loan of $200 for a total of $1,300. You put your numbers in, not utilities, but things that we as lenders consider monthly obligations. And that also includes buy now, pay later type of accounts. So those are what we call undisclosed debts. But to understand from a lender's perspective how we would come up with that, this is the things that we're looking at for you and your monthly payment in your life. You need to understand the full picture. Once we have the back end ratio, right? This is 50% in our example of the $100,000 income that FHA will allow for in this example. And so the next thing we want to do is we want to determine what the cost of the money would be that we're borrowing. The easiest way to do that is to get a standard, if you will, and we'll use $100,000. So typically you can say anywhere between $600 and $800 per $100,000 borrowed on a 30-year loan. You should be pretty good to go because you're just trying to get a ballpark as you move forward. This is why you go through the home loan process and get pre-approved properly so you really can know, because taxes and insurance and incomes, they vary based upon where you are and who you are. So once we've determined these things, we want to get a cost of the credit. So I'm using 6.5% and I'm using $100,000. And what you don't see is we're making the assumption that this is a 30-year amortization, a 30-year loan, or what we call a qualified mortgage. When you do the math here, that gives you a breakdown of the cost to get this $100,000 would be $632.06. Then I want to add in what my estimated taxes and insurance would be, because this is what makes up the principal, interest, tax, and insurance payment for my home, my pity payment. All right. And that front end ratio, this $2,500 here, that pity payment should not exceed this $2,500 a month. If I'm saying I'm spending no more than 31% of my income, my gross income annually, based upon the guidelines. Okay. But we want to, in order to get a factor where we're working to see if that 2.5 times or 3.5 time assumption that I mentioned in the beginning, if you could just use that to give you a ballpark of where you should be, instead of having to go through all of these calculations that hopefully your lender is going through if they understand it. You don't have to do all of that. I digress. We got $632.06. That's the interest cost for $100,000. Then we're going to take in our example $375 a month, because I'm assuming the taxes are going to be $4,500 a year. I'm assuming that the insurance is $1,800 a year. You guys make the adjustment wherever you are if you want to go through the math. You annualize it or divide it by 12, and that's where I'm coming up with those numbers. So we get the cost to borrow the $100,000, the estimated taxes and insurance. And so the cost per $100,000 in this example would be $1,157.07. She was saying earlier in the video, if you go back and listen, once you understand what the cost of the money would be, now what we want to do is we want to take our back end ratio, this $4,167, and back out our monthly expenses, whatever they are, the ones that we as lenders count. And so they total $1,300. So we're taking the 4167, which represents 50% of the $100,000 of the income per our example. We back out the $1,300, and that gives us this $2,867 left. That's the number that we're going to use to come up with our factor to figure out how much home we should buy. And so when we take the 2867, this is the back end ratio, okay, less the monthly expenses, and divide it by the cost of every $100,000 in our example, we get a factor of 2.4%. I rounded up. If you take that factor and multiply it times $100,000, bingo, bango, we get $248,000. Well, Robert, why did you go through this exercise? Because when I tell you guys that if you want to have some bookends as to how much home you could buy based upon your income, if you just take 2.5%, as you can see, we're not far off. And some of you might be a little higher than that because it depends on the interest rate. It depends on the taxes and insurance. It depends on your debts. But in the beginning, or when you're at home and you're trying to get an idea, if you want to be very comfortable, this 2.5 times has been derived over a long period of time of looking at a lot of data. So if you want to be very comfortable, you could say, you know what, 2.5 times my gross income is a number I should be very comfortable with. I'm not saying it's a guarantee either, because you might have a lot of monthly obligations. Your debt to income ratio might be crazy high. But just to give you a ballpark, that's how you would do that math easily. And if you wanted to be aggressive, then I would do 3.5 times. But I wouldn't do this 3.5 times if I had a lot of debt. But that will give you some bookends. And then from there, you can get a good idea online when you look at some of these calculators, if you do it correctly, to get a realistic picture of what a real house payment will look like where you are. Okay, real principal, interest, taxes, and insurance based upon the proper loan to value. Most calculators that you look at online are going to make the assumption that you're putting down 20%. Well, all of these examples that I'm using, and most people, especially with FHA, you're using this first-time homebuyer program because you're putting down only 3.5%, maybe 5%, maybe 10%. Okay, if you're putting down 20%, we need to be talking about conventional loan products possibly, and looking at a higher interest rate, but saving money monthly overall because you don't have some of the additional fees with FHA. Another video. So I said all that to say, to summarize this, if you want to know how much home to buy, you take your gross monthly income, if you're a W-2 employee, and if you want to be conservative, multiply it by 2.5 times your gross annual income, and you should be very confident in that number. If you want to be a little more aggressive, I will use 3.5% to give you the height of that potential purchasing power. But where the rubber meets the road is this: you have to reach out to a lender that you know, like, and trust to get properly qualified. That is how you can determine how much home you could buy early in the process. If you watch this video and you're saying, Robert, you know what, that makes sense, and I'm ready to find out for sure, get an accurate depiction of where I or we stand as it pertains to getting onto the housing ladder, well, you're in luck. I'm a lender. My NMLS license number is 180100, and you can reach out to me by the link that's in the top pinned comment or in the description of this video below. I want to hear what it is that you want to achieve, and if there's a fit, we can move forward so that you can have a real world example based upon your information, what you can afford. If you're not ready to make that call yet, continue watching these next 2 videos to further your education as you prepare to get onto the housing ladder. My time is up, but I thank you for yours. As I always say, guys, let's be good to one another. Let grace abound. Y'all stay blessed now. Indeed.